Hello everyone, welcome to this segment where we're talking about financial literacy for our businesses. We'll look at a few points for this session, and then hopefully we'll have a few good takeaways that we can actually implement immediately. We'll talk about three things. The first one is that cash is king. And then the second one, we'll talk about the importance of the cash flow, comparing it to the income statement and balance sheet. And then with that, we'll be analyzing what the data does not tell you. And then we'll move on to look at budgeting and budget tracking or monitoring, and close up by looking at the internal rate of return, that is the desired rate of growth for your business. So firstly, cash is king, period. Let's consider a business that sells inventory or stock items. You use money to go and buy 1,000 pieces of stock items, and your money is tied in those stock items, and until you sell those stock items, there's no money available to spend anywhere else. So in other words, your money is stuck in inventory. Well, if you look at accounting studies, you find that inventory is a killer of cash. Once your money is tied in inventory, it's not even a viable current asset that you can actually lend against. For instance, you go to a bank, you're looking for a loan or you're looking for an advance, you can't use your inventory as a security or to secure that loan. What is the alternative around this issue? It's just in time stock or inventory management. So order what you think you can sell quickly, order those things that move fast, and make sure that you spin them out or you send them out quickly to get your money back to use in other things. Now, let's talk about money at hand versus the income statement or profitability. If you buy 1,000 stock items and you sell them for double the price that you bought them at, yes, you can say you made 100% profit on paper. From an accounting perspective, yes, you've made 100% profit. But if that money is not in the bank, yes, your business looks good on paper, but there's no money to spend. And so having that money in the bank is first prize. And that once again highlights the concept that cash is king. Cash flow is about how money comes in, the timing thereof, and the timing of when money goes out. So those ins and out, they make out what you call your cash flow. Some in the accounting fraternity call it the discounted cash flow. They use it for planning purposes as well. To say if you're going to do business or you're going to start a project, what is the discounted cash flow of that project? Yes, it's important to look at the income statement and the balance sheet, but simultaneously, there is an important report, which is the cash flow statement, that one needs to look at on an ongoing basis. Because if you don't have your eye on the cash flow statement, you can easily go bankrupt because you can't pay your suppliers, and this is how your operations get stuck or get deadlocked. There are a few things that one can do to actually increase the cash at hand that they have. The first one, you can actually send out invoices for goods and services supplied and put, for argument's sake, a due date of 7 days. Say you send out the invoice, you give your customer 7 days with which they must pay in the money. And then in the same vein, you can actually go to your suppliers and negotiate a longer window or a bigger window, say 30 days for you to pay your invoices. And so what that does, if you look at the difference between the two, is that it gives you a lead time of 23 days with which you receive your money. You can use your money to do other things. In fact, if you use the two windows that I just spoke about, in the 30 days you can actually get 3 payments in those tranches of 7 days, which means that you can use or collect your money 3 times before you have to send it out on the 30th day to your suppliers. That way it increases or enhances your cash flow. And those are some of the techniques that businesses can use to actually increase their cash flows or cash at hand. I move on to the next concept, which is budget planning, monitoring, and tracking. Sometimes we spend money in our businesses, but we don't quite have a plan of how much we want to spend where. And you might find that in business, it's got different business units. And the question is, what is the planned spend per business unit? And are you keeping an eye on how they are spending? And even better, do you have revenue targets for the business units? And then if you match the planned revenue versus the planned spend, you can actually have the income statement measured at a business unit level. And that introduces the concept of business optimization to say, those business units that are not profitable, what is it that you can do to increase their revenue? Or if you can't do anything about the revenue, what is it that you can do about their cost? Because the difference between the revenue and the cost is what makes up your profit margin. So as a business leader, keep an eye on the profit margin. Which business units are not profitable, and what can you do about them, and what can you do to optimize your operations? That's an important question that we leave with every business leader. Having sold your inventory items, what collection methods do you put in place or make available to your customers? You can have card payment, you can have bank transfer, you can have the collection of cash on your premises, but that comes with its own security issues that you need to cater for if you plan to go that route. And another one which is popular, particularly in Africa, is mobile payment methods. Do you accept mobile payments for the supply of goods and services? That could be an important consideration for your business. And you might find that it's actually easier for your customers to pay you. They make a mobile payment transfer, and then you render the service or you release the goods. When you make those payment methods available, you eliminate the blockers of money flowing into your business, and you're actually enhancing your cash flow, as we spoke about its importance earlier. Now we move on to the internal rate of return, or the desired rate of return, or the desired rate of growth for your business. My question to you is, at what rate or what percentage do you plan to grow your business in the next 12 months or in the next financial period? The follow-up question is, what can one use as a benchmark to grow their business? What is the right rate that one can actually attach to the growth variable for their business? Sometimes you find that it's recommended to use the stock exchange. Say you look at the top 40 on your stock exchange and see what their year-on-year growth rate was. Sometimes it could be 15%, it could be 18%, it could be 23%. That actually becomes a guide for you to actually pick one that you can settle for your business. You can actually follow the same convention, or having known what the market growth is based or determined by the stock exchange, you can choose to have your own stretch target, say of 30%. Finally, I'll wrap up by touching on those three important points as reminders. The first one is that cash is king. Receive your money faster than you are spending it or sending it out. Secondly, keep or maintain minimal stock, and just keep the stock that you need or that you are sure that you'll get rid of as soon as possible, and your money is not tied in inventory, because inventory is a killer of cash. And then thirdly, get into a habit of budget planning and budget monitoring, and make sure that you keep an eye on how you spend. Are you spending according to budget? Are you spending faster than you budgeted? And are you getting revenue in against the budget that you planned or not? Which one is greater, and what can you do to optimize that? And with that, I close this segment. Looking forward to another episode of this segment. Cheers.